let me welcome on board Girish Pai and talk about where he finds comfort within IT, or if he does at all. Girish, hi, morning. Great to have you on the show. We were just discussing what the tailwinds and headwinds for the IT sector are. And while clearly valuations are still above the long-term averages, attrition seems to be tapering. Rupee continues to be weak. We haven't seen any starkly negative commentary coming in from the IT services companies back home. And I mean, truth be told, the stocks are down 10 to 30 odd percent, if not more, on a year-to-date basis. Girish, I guess the question on everyone's mind is the worst behind for IT? And is it time to now at least start nibbling into these stocks?
First of all, thank you for having me on your show, Aisha. I continue to remain skeptical on the next 12 to 18-month performance of the Indian IT service industry from a stock market perspective. Primarily because I believe that we are going into an event which is going to be fairly damaging from an earnings perspective and maybe even from a PE multiple perspective, which is a potential US recession. When that is going to happen is a bit of a question mark. 9 months back, had you asked me, I would have probably said it's going to happen in the first and second quarter of 2023. I think that is kind of getting pushed back because consumption has been fairly resilient in the US, at least thus far. So the way I would look at the sector from a structural perspective, going beyond next 12, 18 months is that the starting point of valuations. So if you look at tier one companies like TCS and Infosys, they're trading at about 28, 29, 30 P multiple on a 12-month basis. What kind of money would you make if you hold on to these stocks and if you buy them now and you hold on to them for the next 5 years or so, ignoring all the noise around the recession and stuff like that? I suspect the returns could be somewhere in the mid-single digit territory because I think that the structural growth rate of the industry is not going to be the very strong numbers we saw in FY22 and FY23. I think it's going to slip down to maybe 100, 200 basis points faster than what one saw pre-pandemic. Maybe Indian industry growth rate could be in that 8-9% kind of US dollar growth territory. And I think there's going to be a little bit of PE multiple contraction and earnings will probably be in line with revenue growth. So that's broadly the picture I have for the IT services sector. I think, from a more portfolio perspective, I would probably think one should be underweight the sector as we speak right now. And I would be more underweight at tier two stocks.
All right, Girish, let's just talk in specifics then for what exactly would be your outlook in terms of what some of the headwinds are for the sector as a whole, because we do have, the rupee, which has peaked, valuations still seem to be above long-term averages. What do you think would be some of the key headwinds for the sector going down the line?
So headwinds for the sector would be in FY24, which is the upcoming year, would be revenue growth. I would probably think that from, a teens kind of revenue growth that in US dollar terms that some of the tier one companies have seen. I suspect that growth rate is going to come down to as low as low single digit in FY24. That's my expectation. I think the street is working with maybe like a high single digit kind of US dollar revenue growth for FY24. So revenue growth is going to be the key challenge in FY24. I think the margin issue has broadly been sorted out in FY23 itself. Margins have kind of come in lower than what street anticipated maybe 12 months back. I think what could potentially also work against the Indian companies going into FY24 would be pricing pressure. So we've not, in fact, I think we've been at the, we've probably had a good pricing phenomenon play out for us in the last, I would say, 3-4 quarters where things, they've been gently moving up for some of the companies, and that has kind of helped in terms of holding on to, getting margins up or holding on to margins. I would say that is going to come under, I would sort of think those are the two key elements of volume. Volumes would be under pressure. I think pricing would also be under pressure in FY24. Otherwise, from other thing would be your cross-currency, headwinds that could potentially arise, which have been the case in the last couple of quarters. I think Indian rupee, while it has been depreciating against the US dollar, it has been appreciating versus against versus a euro or a yen or some of the others, which have been putting a little bit of pressure on margins.
The fact that IT companies have option to now do buyback, they're paying a lot of cash back. Could that act as a backstop? So stocks may not go higher, but they will not go lower.
Yeah, Nikunj, so this has been the case for many years now. So it's not something new that the industry is seeing. The good aspects of the industry is that you have very steady growth, very steady, very good cash flows, almost amounting to 100% of net income of the companies. Great corporate governance, all that is there, all that is a given. The question to ask is, what is the growth rate of revenues that one is envisaging, or what is the growth rate in earnings that one is envisaging for this industry? I don't think that is much higher than 8-9%. From a tier one perspective, tier two could be a little faster than that. But I think the valuations at 28, 29, 30 P multiple on a 12-month basis forward is already more than adequately pricing that in my opinion. So yes, there could be buybacks that would come our way. One should also remember, just to put things in perspective, in the last recession we saw during the GFC timeframe, the multiples of some of these tier one companies went down to single digit levels. While I'm not expecting that to happen this time around because of the very strong domestic inflows into mutual funds and even direct retail inflows into the stock market. I think 27 to 30 P multiple, I don't think is sustainable with the kind of earnings growth that I'm kind of anticipating.
Girish, what are the chances that the template what you've just outlined, and this in a sense is getting endorsed by other market analysts also, gets challenged, which is US economy does not contract, outsourcing continues. What looks like a historical pattern where US goes down, outsourcing goes down, may not occur this time purely because of the significance of outsourcing and digital adaptability.
Yeah, that is a view that I think a lot of the my peers on the street, if you look at the sell side view on IT services, it's kind of a mixed picture there. There are a very small, some of my peers are kind of being bearish. There are a lot of other peers of mine who are being fairly bullish on the sector, which implicitly means that they're expecting a soft landing in the US economy in 2023, where you're not going to see even a shallow recession. My base case is an explicit view of a shallow recession in 2023. So yes, there is that view. If that view does play out, that could mean that there could be upside for some of the stocks. But at the kind of multiples that I'm talking about, I think the upside itself will not be very material. Now again, if you look back in history, we've not had a situation where inflation has gone to 8% and thereabouts. In the US, it's been like 40 years plus. And the kind of interest rate hikes that we've seen in a very short period of time, the extent of hikes that have happened, would mean that there is going to be a economic shock that's going to come through. Right now, as I said, consumer is fairly resilient in the US because I think there's a fair bit of savings that's still there. I think that is probably going to get used up at some point in time in the next 6 to 9 months, and that is when we'll probably see a downturn, if not earlier. So, and we've already seen that. I mean, some of the housing-related areas of the US economy are already seeing pain. And if you look at even the IT service industry, you will see sector after sector coming under pressure. So 9 months back, we were discussing what, retail and mortgage part being under pressure. Lately, we've been talking about high tech and healthcare and manufacturing, auto. So it's telecom. So we've seen a broadening of pain, so to speak, from the vertical side. And yes, second half of FY23 anyway is not expected to be, strong at a seasonally weak period. Second half typically tends to be a seasonally weak period. So there's no great expectation from the market side, also from a revenue growth standpoint vis-a-vis the companies. I think the pain, if at all it is going to be visible, will be in the first half of FY24. We'll have to wait and see how that kind of pans out, and we will probably get to know the guidance on that maybe come April of 2023.
Girish, good morning. So just building on that point where you're saying some are bearish and some are bullish, what we started to see recently is
a pickup in the share price, right? At least of the large cap IT companies. So my question to you therefore is this therefore the time to accumulate?
I think this is a good time to actually sell into the strength. So this is so if I look back in history, and I've tracked the sector for almost like 20, 25 years, I've seen two big recessions. One was the 2008-9 GFC related recession. Though the signs of that were already visible in 2006 when there was a inverted yield curve developing at that point in time. And then there was a dot-com crash related recession that happened between 2000 to 2003. And if you go back in history and study the stock price movements at that point, in those years specifically, say 2-3 years, you will see that there is significant volatility, up and down movement of the stocks. So my take is that this is one of those bear market rallies that we are in. So yes, I do agree that tier one stocks are up 15-20% from the 52-week bottoms, lows, so to speak, and tier two stocks are up 30-40% from their 52-week lows. But my sense is this is one of those bear market rallies, and I think it would be good to actually sell into this rally rather than accumulate right now. So as I said, if you accumulate right now, you have to be content with suboptimal returns of say mid-single digit.
Okay, so this is the time to sell during the rally, a bear rally going by your experience and at least 2 recessions that you have been through. And therefore, during this, and if somebody were to look at it, would it be obviously then safer to be with the safer bigger names, you know, the TCS, the Infosys, the Wipros? Because what we've also seen in the last 2 years is that massive run up in the mid-tier IT companies.
Right, absolutely. I would say if I were to build a portfolio right now, I would be underweight IT, and within that, I would be relatively overweight the tier one stocks. I would be putting money in at TCS, Infosys, and NCL Tech rather than some of the tier two names. Though I would kind of say that watch out for LTI Mindtree. While I'm not very comfortable with the valuations that it is trading at currently, but I think that could potentially be a dark horse from a next 5-10 year perspective if they continue to execute the way they have done in the last 2-3 years. Because it is going to be, from a services perspective, it's got on its menu a lot more capabilities than a tier two company out there in the market. And from a size perspective, it is at an advantage because it's about $4 billion or thereabouts from a revenue run rate perspective, annualized. Whereas, some of the tier one companies are about $15 billion. So there is that opportunity. So it could be more nimble, it could grow faster. So would look at it, but not at the current multiples.
Your time. Thanks much, Girish, for joining in and just giving us a sense as to where IT as a sector stands, as well as your overall outlook for the space going forward.